Holy cow, how do you trade this market? I mean, guys, since January, this market has been just hit with non-stop selling. The stock market just can't seem to find a bottom. And when you get these little intermittent periods of buying, like we saw off of the February lows that continued on to the end of March, and then you get the big rally that took place off of the June lows all the way up until mid-August, where everybody was claiming, hey, we're in a bull market again. We got a new bull market upon us, only to see us hit the 200-day moving average and a declining trend line on the S&P 500 and continue the selling again. So now we find ourselves back in this place of, where is this bottom in this market? Are we going to find it before the end of the year? How is September and October, which are historically incredibly bearish, how are those going to behave for us? Are we going to break those June lows? So what I'm going to do in this video, I'm going to talk about 3 things that have really helped me out to getting through this year so far, to remain profitable and actually build my account value in the process. So number 1, not every day requires you to have to trade. I know that the big thing to do as traders, we want to find, what is that hot stock that's going up? Is it BBBY? Is it GameStop? Is it AMC? Is it, what's the Wall Street bets crowds going after? But that's not what we need to be focused on. We need to be focused on, is there an opportunity to trade? Does the market conditions warrant it? Is the stock that I'm trading in a sector that's bullish or justifies the trade? Let's say you're going short. Is the sector itself setting up to the downside? If it's not, then you can't get into these stocks, especially in a bear market. You got to make sure all your ducks are in a row. So this FOMO and this hyped up stocks that, okay, I see a stock that's up 200% today, I got to get in on that action, only to see it drop 50% thereafter. You got to get that out of your system. That FOMO stuff will not work. Here's something that may blow your mind. My last trade was on August 26th. I've been watching the market every day since, as I always do. But I have not found a reason to add to my bearish exposure since August 26th. On August 25th, I added SDS to my portfolio. On August 26th, I added a position in PSQ. Since then, my focus has been managing those 2 trades, taking profits along the way, and then getting to a point in my position size that I feel comfortable with riding this whole bear market lower. My focus has not been to pile on the positions or to feel this unjustified need to go 100% short on this market. No, I'll take what the market gives me. If I could have expanded my portfolio to even more to the downside, I would have, but it didn't justify doing that at the time. So let's take a look at these 2 trades that I'm in here. First off, we're taking a look at the SPY. Now, I don't have an actual position in SPY. It's an SDS, but I base my technical analysis off of SPY. So on August 25th, I got into SDS. That's 2-to-1 inverse ETF of SPY. That means for every percent that SPY goes up, it's going to go down 2%. If SPY goes down 2%, it's going to go up 4%. So it's a bearish position on SPY. On 8/25, I actually got in and I was down 2%. And then it took me into the Jackson Hole meeting, which I was very confident that Jerome Powell was going to come out very bearish because he had to. He really had no choice. Despite the fact that the market was talking about this huge Fed pivot, he couldn't afford to goose this market any further, because in doing so would ease the financial conditions that was causing the market rally already. So immediately, going from 2% down, I saw my position immediately turn green, and I've been riding it all the way down since. So I'm still in this SDS position with about 13% in profits. So once Jackson Hole happened, we can now focus on SDS, because that was what I was managing the trade on. Now I'm up about 3 or 4% on the trade. That following Monday, August 29th, I took my first quarter of a position off the table. That left me with 75% of a position for a 5.4% profit. Now, 2 days later, I'm taking another 0.25% off for a 9% profit. So as you can see, I'm taking profits along the way. Yes, I know at any given time, the market may reverse. And then you get this little candle right here, a Thursday of last week, which I wasn't sure if that was starting to create a problematic dead cat bounce. But I took another quarter of my original position. But what I did there is I took a 1/6 of my original position off the table to bring me down to 1/3 of my original SDS position. That next lot that I took off, that booked about 11% in profits. And so here I am. Now I'm writing it out. Same thing could be said about PSQ. Once Jerome Powell spoke following Jackson Hole, I realized that that was my opportunity to add some more bearish exposure in the market by getting into PSQ. Now, PSQ is not as aggressive as QID. It's a 1-to-1 inverse ETF of the Qs. So all it's going to do is match in the opposite direction whatever the Qs do. But again, this one provides a little bit less volatility, which is what I was going after here. And I was going to let the meltdown in tech do the heavy lifting for me. So I didn't have to take a very high beta position. And that included me taking profits on August 30th for a 4.3% profit. I took 1/3 off the table there, and then I took another 1/6 of a position off on September 1st for a 6% profit, which gives me a half position. So I have a third now in SDS and a half position in PSQ. And now this brings me to my second point, where I'm wanting to set myself to be in a position to where I can weather any kind of a bounce that comes from the market in the days ahead. Now, I don't want a big bounce like what we saw off of the June lows. If that happens, then I'll be getting out of my positions because I don't want to weather that much of a bounce. But if we can get a 2 to 3 day bounce where, okay, maybe stocks rally like 1.5 to 2%, maybe even 3%, then I'm okay with that. And what that does is that it gives me my existing trades still intact when the market starts to turn back lower again. Plus, I can add new positions. Let's say I add another 2 positions. Well, then now I have a much bigger position size than what I had initially when the market started selling off after Jackson Hole. So going back to the charts here, what I want to be able to do is see a nice bounce off of these lows so far in September. You look at the daily chart, there's definitely an oversold nature to this market. I don't think it's massively oversold, but I think it's enough to where we could warrant a 2 or 3 day bounce. Maybe it takes us into the end of this week and we see a resumption of the selling the following week. Holiday weeks tend to be more bullish than non-holiday weeks. So this lines up perfectly for just that scenario. So if we get that, let's say we get up to the 50-day moving average and we start to see prices start to fall apart again, that's where I want to start to be more aggressive in adding to the short side. So managing my positions and putting myself in a situation where I can weather the storm of a market bounce, thereby allows me to be able to be even more aggressive on that next leg lower. So I'm putting myself in a situation to where the emotions are not going to rattle me. It's something that I can handle. I'm not going to make any trading decisions based off of emotions or panic or fear or greed. I'm going to follow the charts. And that is very important because most of the time as traders, we don't do that. We let emotions guide us. Whether we want to admit it or not, the bigger your position size is, the more emotional you're going to be about your trades. Now my final point, number 3, lose fast, win slow. We talked about managing the positions as it's getting more profitable, take something off the table, but equally important is not staying in a losing position for long. I want to be able to get out of my losing trades and into a winning trade as fast as possible. So if I'm not going to be right, I don't want to spend much time on that trade. Let's get knocked out and move to the next one. That's why we have to be okay with losing. If we're not okay with losing, we'll never experience what it's like to be a consistent winner, because the manner in which we win is defined by how we lose. If we can't take a small loss, there'll always be big ones. We got to make sure that we're not over trading in this market. Less is more in this market. When I trade too much, that's where I start to see my profits dwindle. Versus when I'm a little bit more patient, when I'm waiting for those right trading opportunities, it's so much better for me. So don't feel that you have to trade every little turn in the market. You don't have to trade every stock that's going crazy for you. You want to just wait for the opportunities that when you see it, you know it, and you're able to execute it with a plan that manages the risk, keeps the losses small, and sets you up for success. If you enjoyed this video, make sure to like and subscribe. It helps me out, man. I love hearing from you guys down below. What are you doing to get through this bear market? I want to hear all about it. Thank you guys, and God bless.